think 5 or 6 different companies, done it every which way. So I've bootstrapped, we raised in one of them almost 50 million. I also have done other ones as kind of, ones that built up and then sold relatively quickly. So kind of have looked at it from all different perspectives. Right now I have a couple different projects that are under my purview that I started. One is With Me, which is a reverse auction type platform for restaurants and bars, which is doing nothing right now because nobody's going to them. But the idea is you say what you want to do and with how many people, and then you can go to that, you get bid on as a customer. So the restaurants will compete for your business. And then I have another firm that's doing a lot of stuff with blockchain and other things, projects in gaming, projects in a variety of spaces. So that's a quick brief for me.
Okay, Mike.
First of all, thank you, Carl and Kathy, for hosting this virtual event. I know it's hard to imagine how everyone's adopting, but I think we're at the point where life is starting to move on, and I'm glad that we could be here to support the entrepreneur community in Maryland. And as far as Texas, I don't know if anyone else is further than that on this call, but glad to be supportive, and thanks to the other panelists for joining. So long story short, I'm Mike Leffer, a principal and member of the founding team at Squadra Ventures. And we are a relatively new early stage venture capital fund led by founder operators that invests in enterprise software, specifically that drives value, efficiency, security, or top line revenue, located in the Mid-Atlantic or other emerging technology hubs. And our big emphasis and highlight of our thesis is that we apply significant resources beyond the check post-investment, helping companies build the growth engine, working hand in hand with our entrepreneurs and our portfolio companies to win and really leave a lasting impact on the world. To date, we've invested in 5 early stage technology companies from Baltimore and Northern Virginia as far as Boston and Hawaii. And we're looking to support more entrepreneurs.
Thanks, Mike. Scott, go ahead and introduce yourself.
Hi, everyone. Can you hear me?
Yes. Okay,
perfect. So Scott Garber. It's always weird doing this virtually and not in person, but that's a new reality, I guess. So like Mike, Early Light Ventures is an early stage enterprise software fund. So what that means is companies that are, we say 400K in recurring revenue up to about 3 million in recurring revenue with the need to have products and very limited, if not zero churn. And it can be a cybersecurity company, health IT company, it could be a construction technology company, it could be anything that's enterprise software as long as it fits sort of the metrics we're looking for. And like Mike, we try to roll up our sleeves and add value. We're a smaller check in some cases, we're a larger check in other cases. We've followed, we've led, we don't really care. We just want to add value and find the right companies. And we do have a preference for Mid-Atlantic based companies because we are based here as well.
Awesome, Scott. Corey, go ahead and introduce yourself.
Hey, Carl, thanks so much. And yeah, to mimic Mike, thanks so much for having me and giving all of us the opportunity to get together. I've known Carl for a few months, and I have the pleasure of having met Scott and Mike in the past. And Tim, it's a pleasure to meet you as well. I am the CEO of DataQuip, a company that's been around for about 2 years that uses existing data from existing commercial facilities to use what buildings already have to make them 15% more efficient. We work mostly directly with commercial owner and operators, as well as we have channels to market through major utility providers as well. We are up to about $1 million in ARR, or we did $1 million in the last 12 months. Our current effort is mostly directed at a $1.5 million seed round that we have funded about half of to date. And we're looking to close that out as quickly as possible. And yeah, excited to be here. I think the advantage I can provide is I'm kind of actively on the street marketing the company, so I'm right in the middle of it. So anything about directed at that segment, more than happy to address.
So how are you getting out on the street, Corey? I thought you were supposed to be locked in your house.
Very carefully, Carl. You'd like to know.
All right. So I want to start with Corey, because Corey's a first-time entrepreneur, right? And so this is his first rodeo, if you will. He's managed to raise a little bit of money, and then I'm going to go over to Tim, because Tim's got a lot of scar tissue. But I want to hear what it's like as a first-time entrepreneur out raising money in this environment.
Yeah, absolutely. I mean, you know, a lot of fundraising, I think that people overlook. It really has to do with just listening. Listen to what the investors are telling you, listening to what's going on in the street, listening what's going on into the market. And you really don't have a choice but to adapt. I think really the only thing that's changed for me in the current environment is where focusing significantly from a features and benefits standpoint on how DataQuip can actually be useful during a COVID-19 crisis, or a crisis like this where we can't access commercial facilities, where we need things like remote data monitoring. But other than that, not much has changed. You know, obviously this is a major situation. I don't want to make light of it, but it's actually been really nice. I've been able to hold more meetings per day and stay out of the car, and I'm actually my output and number of investors we talked to has actually increased since the COVID-19 crisis. I think we're going to see less checks issued, but that certainly doesn't mean that we can't all be working on our pipelines and developing relationships in the meantime.
Okay, so Tim, you remember back the first time you went out to raise money as an entrepreneur? Does it get any easier?
I think it gets a little bit easier in that you already have established connections. You have a track record, so to speak, good or bad, if things went successful or not, if you establish a rapport with your investors and whatnot. So you get to build those relationships. But I mean, at the end of the day, every day that you're working and networking with folks, you're building a network of people that will help support you going forward, be it an investor, potential partner, potential employee, whoever it might be. And so I think it just naturally gets easier the more you go down drive down that path. But, you know, with that said, there's always, you know, fit and whether or not you fit in with the investors. If you're changing, you know, I did a lot of fintech stuff. We worked with a lot of you know, kind of banks and other folks that were investors, as well as other VCs and so forth that were more in the fintech space. And they may not be in, if you're doing a CPG company or something else, they're not interested in that. So sometimes the relationships aren't transferable into a new venture. But I think, you know, it's one of those things. As you build your track record, you're able to, you know, hopefully connect up with folks better, and you have a better idea of how to interact with them and what they're looking for, and how you can fit.
Thanks, Tim. Well, Kathy, I think that the folks in the that are participating here can't put the questions in the Q&A because I think they're all panelists. So I'm going to go ahead and close the Q&A, and I'll just look in the chat room here. I see some questions coming. So let's go over to Mike. And I'd like to ask you, Mike, how has the funding environment changed from your perspective with the whole pandemic and the change of environment? Have you stopped funding, or are you still looking at deals?
Yeah, so I think it's a really good question, Carl. And there's a couple of different layers to it. And I think with all of these questions, the answer is it's going to be 100% dependent on the specific investor. And what I'm doing is going to be different than what Scott's doing versus what Tedco is doing, et cetera. But what our approach is right now, first and foremost, once we identified that COVID was going to have a significant impact for an indeterminate amount of time, was help our companies reassess all of their assumptions, everything from financial models to go-to-market strategy to determining at-risk customers they have or contracts future that would be at risk, and help them build a new plan and get to 18 to 24 months of runway through some combination of reducing burn or accessing capital, you know, venture debt, whatever it may be. And that's really been our priority, I'd say, for the last month and a half. And now we're finally at the point where everything's in a good spot and we can finally take a breath and start actually paying attention to companies that are potential new investments. So we're finally having those conversations now. But in the full transparency, of course, our priorities have shifted to being defensive because of the uncertainty in the market. But that being said, I know there are investors that are 100% focused on making new investments. Does that make sense?
Yep. How about you, Scott? What's your take on the current situation?
So it's challenging and it's changing every 5 minutes. We never really know what's going to happen day to day or hour by hour. Not even the White House briefings, just in general. No one really knows what's going to happen and where this thing's going to happen, where it's going to end, how it's going to end. No one knows. Most of the funds I've talked to are doing follow-ons for existing companies. They're not doing new rounds. Or they'll occasionally do a new round, but it's got to be such an absurdly aggressive valuation that the founders don't want to do it. We're kind of in both camps, where we're watching our companies closely and we're helping them get as much money as they can from the government, which has been a challenge. The first round, maybe 40% got money, and this time it seems like another 40% are getting money and 20% are still kind of trying to figure out what to do. If you apply to one bank or 5 banks or 10 banks or no banks, or they don't really know how to get the money. We are making new investments. We're about to close our 9th investment in the fund literally this week. We're looking at a 10th. We did one about 3 weeks ago, but valuation-wise, they were very aggressive. One was like a 4x in ARR, and it was growing 6% month over month and had great metrics. One of them was a 2.5x in ARR for a company that had 3 acquisition offers a month ago. And the 10th one we're looking at is sort of like a barely even, I would call it a venture deal. It's almost like a micro PE deal that I'm working on with a friend. It's an ed tech company actually in Maryland. Mm-hmm. And it's an odd deal. It was a 2.5x on revenue deal that a huge PE fund was ready to do and walked away from a month ago because of everything that was happening and all the furloughs and all the revenue risks they had. And we made up buying it for 1/5 of what they were going to buy it for, literally 2 months ago or a month ago. So it's a constantly changing market. We're watching it. We're definitely still investing, but we're being really opportunistic about it.
Yeah, there are getting deals done. I know that because I follow all this stuff, and when I see a big funding event, I'll ping the CEO and congratulate him or her. And the interesting thing that's different in the market today is people are happy to hear from you. You know, they're happy to connect, and it's a lot easier to get people to communicate about what they're doing and what they're thinking and stuff. So I had a question, and I'm going to direct this around the panel, all right? Because I think a lot of the entrepreneurs around at least this group have this question, and that's around attracting investors pre-revenue for a great idea. Now, I heard each of you say that you, Mike and Scott, that you required a certain revenue threshold. And then Tim, I know you come out pretty early with your deals sometimes, and I don't know if you've raised money pre-revenue in the past. And then Corey, you certainly had plenty of revenue before you started raising capital. So what is your recommendation to pre-revenue companies? Let's go around the panel. Tim, why don't you go ahead and go first since you've done everything?
Sure. So in 2 of my companies, we did raise money pre-revenue. Part of it depends on the environment, right? Sometimes there's, less companies, more dollars chasing them, easier to get that. And it's easier to navigate. I also think it depends a bit on geography, unfortunately. So, certain places, the Valley is much more keen on pre-revenue type investments than elsewhere. And, that's fine. More recently though, I've erred on the side of, I think it's better for everybody in the ecosystem. If you have an idea, you can vet it and get to a point where you're generating revenue, have a good idea of your metrics, your CAC, your LTV, all that kind of stuff, depending on your product. And you can actually find a way to, model out based upon real true numbers rather than guesses that you have something. Even with low revenue numbers, you can have a better conversation with a potential investor that's aligned with you and get to a palatable valuation that doesn't put all the risk on one end or the other. Kind of all ends of the spectrum there.
So Tim, when you raised those pre-revenue rounds, was that a different era? I mean, I know back in the 90s, people would throw $3 million at an idea.
Yeah, and that was a different era then, because those were in pre-2000s companies that we raised pre-revenue.
Yeah, those are the good old days, guys. It's changed a lot. It's you gotta scrap around a little bit. How about Mike, Scott? What are your thoughts on pre-revenue companies that need to raise capital?
Yeah, I echo all of what Tim said. There's a lot of different variables that come into play. Um, I'm gonna say a couple things. One, the thing you can do as an entrepreneur that will increase your chance of raising capital the most is build a great company and demonstrate validation and get it as much traction as you can before you raise capital. And you know, in some ways it's counterintuitive, but if you spend all of your time fundraising and neglecting the business, you're not going to build the business and demonstrate the traction that the VCs want to see. So it's sometimes not what a lot of founders want to hear, but the founders that are the scrappiest and the grittiest will get to a point where they validated what VCs care about at the early stages, given this environment and the times and everything else. So for me, as a fund and personally, we've invested in 2 pre-revenue companies, both of which have now generated significant revenue. How were we able to identify that upfront? A couple of things. One, they had teams who had deep subject matter expertise in the field. 2, these companies were built on significant intellectual property. And 3, they had demonstrated customer love and validation, not necessarily through commercial contracts, but you know, perhaps they had a DARPA contract and they had a customer lined up within the Department of Defense or the intelligence community. And we could sort of see that trajectory based on our experience with previous companies. So it's not impossible to raise money pre-revenue. There are funds out there that are much more willing to do it. The barrier is a lot higher in terms of the team and what the product actually is. I don't want to say you can't go raise money for a dating app pre-revenue, but it's harder than if you have a proprietary fuel cell based on technology that only you have access to, if that makes sense.
Okay. All right. Let's see, Corey, so what are your thoughts on this, and how did you manage to pull in all this revenue before you went out and raised money? That's what I think a lot of people are wondering, how do I do that?
Yeah, and thanks for reframing the question, because I could not have answered that any better than Mike anyway. So thanks for the parachute. Yeah, that's something I can address a little bit better. So I'll add one comment. Ask yourself why you're not able to generate revenue. And the challenge better match the payoff. So in other words, if you're in the biotech community or biomedical and you need some kind of compliance to come through, okay, there's a massive potential payoff for that. If the payoff is you're going to raise money so you can, hire developers on, Upwork or something, that's not a pop from a milestone that investors are going to be very interested in. So the first challenge I would offer is, why is it you can't generate revenue? For me personally, first of all, I decided I wanted to be in the software business. And the barrier to building software, at least an MVP that you can go to market on, is relatively low. And I didn't see a response from the individual who asked the question, but I was trying to frame this to what vertical they might be in. But for me, being in the software space, and we had just enough intellectual property, or call it trade secrets or know-how, from my kind of previous venture that I was able to carry over, that it gave us just enough unique differentiation in the market that we were able to find strategic partners. And if you can find a strategic partner for your business, you're a lot more likely to catch traction from somebody their business has expertise in the same area as your business, but you bring differentiated value to their business. Then they can effectively, this is terrible to say, but it's the truth, they can effectively hide the fact that you're a startup and take your services to market. And that's effectively how we did that. So we established a strategic partnership with Pepco, the major utility in Maryland. We essentially worked up an RFP with them, an RFQ, RFI, whatever you want to call it. We satiated all those details, built our product around it, and essentially made it impossible for them to not use us. We went and landed our first couple jobs ourselves, kind of touting, look, clearly there's buy-in in this product. It's been approved by a major utility it's a publicly traded company, or owned by a publicly traded company. There's a lot at stake here. And that validation was enough to get us over the customer hurdle. And then the customer hurdle became the validation for additional customer hurdles. And that's why we were able to achieve some organic growth early on. And you know, the other thing is too, is like, there's no panacea. Like, it's hard either way. Like, as soon as you start generating revenue, now that takes up all your time. So then the fundraising suffers, right? So you're always going to be juggling. But I mean, the investors on this call, you know, Scott and Mike, you know, them and every other investor I've ever talked to, you know, actual dollars changing hand. I mean, nothing's going to beat that.
All right, so Tim, I want to talk to you about the pivot. All right, so Tim was involved in the sports gaming business, and you know, if you were involved in sports or restaurants, you know, 4 weeks ago, you know, maybe you need a new plan. And so I do a touch base with Tim, and he's got this business where he's going into stadiums and cleaning them out. To talk to us about how in the world did you pivot that fast?
So, well, we still have the sports gaming thing, and it's basically like athlete-centric games that people can play and win prizes and whatnot. And we're still working with some of the Major League Baseball and other teams around, you know, simulated games, things like that they can use to engage their customers. And we're working with some leagues about future stuff as well, like rugby and whatnot. So that's still going on. It's just a different environment, as you said.
But what's it's a BioShield? Is that what you're doing?
Yeah. So we you know, kind of, I'll give you the backstory. I advise a company that does, they create wraps that go around the little conveyor belt at the Giant Food or any of the supermarkets, right? And they put a wrap around it that has advertising on it. And they have a antimicrobial coating to it so that it kills bacteria. And so I've been advising them for a while. And then when this started taking shape and it seemed like it was likely the novel coronavirus was going to come, you know, go global, I started thinking about, well, that's not going to be good for my businesses. and B, I can't really solve the problem of, you know, how do I pivot my restaurant app if there are no restaurants, right? Like I can't, it's hard to do. So we started thinking about, well, what could we do in this environment? And so we started kind of working on, you know, ideas around that married up with what we had been doing, the relationship we had in sports or in restaurants or wherever. And can we build a product that would help solve some of the problems and address some of the risk in the market? So we built and have prototypes and designs and are in negotiations with a few big stadiums about delivering custom products that are plastic products that can be put over door handles or seats or wherever, anywhere, for these stadiums that are infused with silver nanoparticles. And we have some guys at a big university that have been helping us with the kind of ins and outs of that. I'm not a scientist by trade by any stretch. And so, but it's really effective at killing all sorts of bacteria, viruses, fungi, everything, including, hasn't been tested on the current coronavirus, but on previous ones it is effective. And it'll kill 90% of it within an hour, depending on how much nanoparticles you put into it. And so we're working on that now and have had some really good success on that. But it's just, you know, you kind of see an opportunity, and if you have the ability to tackle it, you go after it.
The funny thing about this is, so Tim tells me about it, he sends me over a deck, but he's not even telling me he's raising money or anything. And of course, I'm talking to investors every day, and I've had a few come your way, haven't I?
Yeah, I am not actually looking for investors, but it's always nice to have people look at it. You know, I'm a big fan of, you talk to more people than less. And, you know, people ask me for help, I help them. And, you know, it's just a one big community helps everybody else. And it seems like Carl is the epitome of that. So I appreciate it.
Absolutely. Absolutely. So Mike and Scott, I was looking through both your bios prior to this meeting, and I noticed that way back at the beginning of your bios, you both had entrepreneurial experience. And I wanted to know a little bit about how that entrepreneurial experience led into what you're doing today, because this is another thing I get asked all the time. And I'm sure there's some aspiring venture capitalists on this call who's, you know, they call me and they say, you know, can I become a venture capitalist? And I say, well, yeah, if you know LPs, or if you're a good operator and you've made venture capitalists some money, that's usually your ticket to become a venture capitalist. How much did your operating experience play into you becoming a venture capitalist? Start with Mike.
You go first.
Yeah, go ahead. Oh, he muted. You both muted. Come on.
All right. Okay. So yeah, long story short on my background, I went to West Point for undergrad. And when I graduated, I went active duty in the Army, but also co-founded a tech-enabled services company called Shred Athletics. My co-founder, my best friend at the time from high school, was drafted by the White Sox, throwing 95 miles an hour as a lefty. And he had random people reaching out to him online saying, hey, can you train me? So we built like a really thin tech layer that enabled us to provide 100% customized training programs for baseball athletes. We were charging $500 per month, and we could stack about 60 athletes per coach, and built a really, really good lifestyle business over the course of, I was in it for 3 or 4 years while I was active duty. I went through a typical Rocky patch. As a member of a team, we bought one guy out because they got into a fist fight. They became best friends again, and then they tried to force me out of the company, and it was a month where I didn't sleep, and I negotiated my buyout. What that means is I came out of that with a lot of empathy for other founders. So at the very least, I could have a conversation without being a super transactional finance bro, because I mean, I like to think I appreciate some of the nuance. I mean, I didn't raise 30 million of venture capital like Tim, but I've experienced some of the struggle. And to be frank, I never particularly wanted to be an investor. I saw an episode of Shark Tank back in the day and thought it was stupid, and Mr. Wonderful was an ass, pardon my French. But I think what really catalyzed it for me was seeing how much impact I could have on so many different companies at the same time, and how many jobs we could help create, and how much impact at a really high level. So that's my story. I don't know if I answered your question, Carl, but the big takeaway is empathy from being a founder helps you develop those relationships with other founders, which is critical for deal flow to get into VC.
Yeah, so I totally agree, because my background was, 4 years without a salary as an entrepreneur, and 2 venture-backed blow-ups back in the early 2000s. And so, my entrepreneurial days are over, but I'm very empathetic to, guys like Joshua and others that come to me that are, struggling to try to get something off the ground. So Scott, go ahead and talk a little bit about your operating experience and how it led into your venture experience.
Yeah. So I get this question a lot, and it's a good one. So I became kind of an accidental venture capitalist. It wasn't my intention to do it, just like Mike. I was always a deliberate founder, and I'd always had random things in high school and even in elementary school. There was this business who here had Beanie Babies?
Oh, I didn't.
A lot of people. Who had Pokemon cards like way back in the day?
My kid did.
A lot of people. So I was 12 when Beanie Babies took off, and I remember giving friends like $20 or $30, whatever I was making mowing lawns, and they'd go buy Beanie Babies and then bring them to me, and I'd put them on Amazon or eBay, and I'd sell them for like $10 or $15 or $20, and I'd sort of pocket that money, and I'd start investing in the stock market, and I'd buy baseball cards, and then that got to Pokemon cards, and I learned how to code, and I did a Pokemon website when it was really popular, and these like little like pseudo businesses which made me a little bit of money and were kind of fun. That actually led to a real business in college with the co-founder and I. It started off just like Mike. It was basically a beer money business, and it was a business that helped my co-founder get an A in one of his classes, and went from buying a keg or two to this actually could be a real business. Let's expand this. And we built it over 2 years and sold it 2 years later, and started a second company immediately after that. It was a technology company, just like the first, a little more deliberate this time, raised a little bit of venture money, saw sort of how the venture scene worked and how it didn't work, and realized that it takes forever to get decisions. Most VCs I talked to, at least at that time, that was 2008. Some of them were founders, some of them weren't founders. The ones that weren't founders were a mixed bag, but a little bit harder to connect with, because I didn't feel like they really understood what they were talking about in a lot of ways. It was a tougher way to connect with them, because it was talking, you're in that battle, when you're a founder, it's awesome. It's the best thing ever, but it is a constant roller coaster. It's highs, lows, highs, lows, highs, lows. And it's just like coronavirus. It changes every 5 minutes. You don't know what is going to happen ever. And you have to keep rolling with it and be persistent and kind of learn from it and pick yourself up when you fall down, which happens all the time. And when you've been in those shoes and you've seen what happens there, it's a lot easier to relate to a founder. It's a lot easier to actually understand what's happening in the business when you're evaluating whether or not you want to invest or not, and at what valuation to invest in, what terms to invest in. And then when you actually do invest, how to add value and how to, I don't know the best polite way to say this, but give money when they need money, but also get the hell out of the way when they don't want you there, which does happen. And I, being a founder, I had venture fund investors, and some want to be more hands-on and some disappeared and some kind of were in between. And I always like the ones that said, hey, like, what do you need? What can I do for you? And then they did the help, they did what I needed, and then they got the hell out of the way and I could run the business. And that's sort of how we invest and how I invest. And it's been really helpful. It probably did help me get into venture capital because I had that background, and it was, I wouldn't say it was easy, but it's a lot easier for me to get deal flow and sort of get the network built up because I already had a network here. I wouldn't say it's a requirement, but I definitely encourage a lot of people that want to get into venture capital, go be a founder first, to go join a startup and go see what it's like, because there's no comparison unless you've actually been in a company. It's just a totally different experience.
Yeah, and I can throw this in there too, because I actually raised a small venture fund with two guys several years ago, and it's hard being a venture capitalist too, because you have to raise money as a venture capitalist. It's not all, the glory stuff that you see when they have their fund. Raising a first-time fund is really, really hard, really hard. So anyways, so we did get a question here about geography, and Kathy, I hope they're not all moving to the West Coast and out of Frederick, Maryland. Most of you are from Frederick, Maryland. Somebody said something about the West Coast being more, less risk averse or something like that. And so right away, people start wondering, do I need to go to the West Coast? And so I want to throw this out there, but I do want to say, I have, half of my business development team is on the West Coast, and I talk to those people all the time. And it's not that easy to raise money out there. If you're a founder who's had an exit in the past, it's easier to raise money. I mean, if you've made your VCs 10x on their last deal, yeah, it's easy to raise money as a founder, even if you have a stupid pre-revenue idea. It's not, you're not going to necessarily move to the West Coast and be able to raise money pre-revenue. And I just want to throw that around to the folks on the panel to see if you agree. Tim, you've raised all your capital and had your exits here on the East Coast. Have you ever been tempted to move out West?
No, this is a personal preference, but I can't stand it in the Valley. We raised money here. We raised money, on the East Coast. I sold my last venture out to a company that was out in the Bay Area. So I had to go out there quite a bit during that transition period. But yeah, most of my stuff has been on this coast.
What do you think, Scott, Mike? Do you think the West Coast provides some sort of advantage?
I guess I'll jump in. I think it depends what kind of company you're raising money for, what stage of the company you're at, where you are in the Valley, if it's in the actual Valley or San Francisco, wherever you are. Your background is definitely key. Like Tim said, that's key. I think the amount of money out there compared to here it's orders of magnitude bigger out there. I mean, it could be $1 here and $500 out there. It's not that stark, but it's $1 to $10 or something, $1 to $20. And the risk profile out there, especially if you're early or pre-revenue, they'll take a lot more of a chance on you if you can sell that vision and sort of say that I've got someone that's ex-Amazon and ex-Google or ex-Stanford or whatever big name you want to throw out there. Mm-hmm. And they'll take a chance and they'll write a $100K check or $200K check as an angel, and they won't even blink. Versus here, we're getting a $100K check or $50K check, or even a $10K check from an angel varies, but it's dramatically harder.
So is it primarily on the angel side that it's easier, do you think?
There's also a lot more funds out there. I mean, there's lots and lots and lots and lots of stories I could tell just since I lived out there for a little while and saw it. But there's one example, this accelerator called NFX Labs. It was pretty new a couple of years ago, and now it's more well known. And one of my early investments was in NFX. And I remember meeting with a founder who had sold his first company. It was like a $60 million exit. He'd raised a ton of money, so the investors didn't really make any money on him, but it was an exit. Super, super, super smart Israeli guy, and kind of typical developer type, hard to read, not a lot of a personality, trying to sell a big vision, but clearly incredibly smart. And he was showing me his emails, and he had something like 56 inbound requests from VC, from funds out there that were credible, that had money, that wanted to invest, just based off of seeing a 2-minute demo. And he'd tell me stories about how we'd go get coffee with him. It was like a 30-minute meeting. They'd barely ask any questions. They'd have him talk about his vision, and then they'd say, all right, I'll give you $2 million at like 15 million. pre-money. He had no money. I mean, he had no actual revenue. He just finished his products. You never get that here. It's just a completely different ecosystem.
Well, I'll tell you what I've been hearing lately. So when I started doing this, you had to be in the Bay Area or near the capital. You needed to be near, New York or Boston, where the VCs were located. Anymore, I hear when I'm talking to VCs on both sides of the country, will invest anywhere but the coasts. That's a trend that I've been getting. And so when I show up with a company out of Columbus, Ohio, investors get excited because there's lower valuations expectations in a place like Columbus, Ohio, and there's less companies coming to poach your developers or your employees. And so those are the things that I've been hearing lately. I don't know, have you heard any of that as well? Panelists? Tim?
Yes.
Okay.
Yeah, there's a lot of funds that are trying to raise funds on the premise of investing in the East Coast and second tier ecosystems. I'm not going to lie, we're doing that too. And we're seeing a lot more deal activity going on in those quote unquote second tier cities like Baltimore, Columbus, Chicago, Detroit, Pittsburgh, and there are more funding opportunities out there because of this movement.
Okay, so I got a question here. Has anybody ever raised money in the Midwest? Should companies in the Midwest look out to get more from the coasts? And there's people talking about Chicago and other areas. So, any other thoughts on geography?
Go talk to M25, you Midwest folks.
Okay. All right. And so I had another question come in about valuation expectations during the COVID crisis. How has this affected valuation expectations, both from an entrepreneur side? So let's go ahead and talk. Corey, you've been quiet here. Have you had to adjust your valuation expectations? And then we'll have Tim talk about his, and then we'll have the guys with the money talk about theirs.
Yeah, so I'll actually tie this into the last question, which is, dealing with relatively pragmatic investors is not all bad. We've raised most of our money out of Maryland, and, we've started talking to larger funds on the East Coast, and we've actually gotten some unsolicited interest internationally. But, when you deal with pragmatic folks, it forces you to build your business on sound fundamentals and be honest with yourself, which is not always the most comfortable thing. I'll even fully admit that like Mike and Scott, have asked me tough questions about my business, and looking back, I'm grateful. I'm absolutely grateful, because what's happened is, now that we've hit this COVID-19 situation, I was much, much better prepared, and I actually don't have to adjust my valuation because it's somewhat realistic based on what was going on in the market before, and not too steep based on the market thereafter. And it's sorry, I'm watching Mike laugh in his camera and I'm dying to know what he's saying. But it's one of those things where it's not all bad. But yeah, I mean, I think if you look at the margins, and I've been looking at some of the reports from SaaS Capital and things like that, and yeah, I mean, there's no denying the multiples are dropping.
Okay, and so Tim, have you changed your valuation expectations?
I mean, since we're not raising that, it doesn't really matter to me as much, or, looking for an acquirer or anything like that. So it's less relevant to me, but I mean, I've heard, inklings and rumors around that it has obviously changed. And I think Scott had referenced, some of the things he's seeing firsthand within the last weeks. So I think they probably can provide more color that's more tangible.
Okay. And Mike's cracking up over there.
Yeah.
Mike, what's
Sorry,
so funny?
I'm having a conversation outside. I'm gonna be right back.
Okay. So Scott, have you changed how you're approaching valuing companies with the whole change in the market here?
A little. I mean, we were always hyper aggressive on valuation and multiples, like Corey referenced. We would always invest at, I would call it conservative valuations. You have one example of being on different areas, like West Coast valuations obviously vary. There's a company or a fund called Right Side Capital, which is like us, that's really conservative in the middle of San Francisco. There are a lot of other ones that invest at 30 to 50x in ARR out there and are still doing it to some extent. And that's pretty normal just because there's so many funds and there's so much money and there's competition for deals. Here, there really is no competition for any deal ever. And the valuation multiples are typically a lot lower. The highest I really see in this area is like 15, maybe 20x on a seed stage deal or an A stage deal. We always did more like 4 to 8x, 4 to 9x on ARR was kind of the max, depending on churn and growth and all sorts of different factors. The exit pathway, who acquires them, all sorts of different other scenarios we run. COVID's definitely impacted everything. I mean, a lot of people that had rounds more or less circled and ready that weren't actually closed before maybe mid-March, dragged out a couple extra weeks and their valuation fell 30, 40% in a month. And these are good companies that are continuing to growing. They're not getting hit by COVID. The ones that got hit by COVID were either didn't raise the round that they were going to raise, they closed it up really early, or their valuation went down 60% in a month. And there's a lot of companies like that. And I think it's just getting started. So we're investing a little bit more aggressively on valuation. It's 2x in ARR up to maybe 7 at the top end, just because there's so much uncertainty. We don't know what the exit looks like. We don't know when the exit's going to happen. We don't know what the revenue is going to look like. We always looked at burn rates. We always looked at runway, because if you're low on money and you don't have leverage, especially in an acquisition or raising money, whatever it is, if you don't have leverage, you sort of get in trouble. So we always look at that, and we're looking at that more now. And we want to see at least 18 months of runway from every company we invest in.
Okay, so I had a question about formulas that VCs use, and I think that your answer, Scott, just answered that question. They were asking about price to earnings ratios, but you really do ratios on the top line revenue, right?
Yeah, it'll vary. I do gross margin too, because gross margin obviously is a key factor. Some have 90% gross margin, some have 50% gross margin, and it's not a complicated thing I use. I literally will put it in. I think Mike's probably even seen some of these. It's a Google sheet I put stuff into. Yeah, it's a pretty basic thing, but it tries to figure out what the IRR looks like based on what an acquisition looks like, based on what their growth looks like over the next 5 years. And it's not complicated, but I can play with certain scenarios. And typically we want to see low end 25% net IRR, high end probably like 50. But generally most of our deals are like 25 to 45% IRR in most realistic cases is what we look for.
Okay, when you say gross margin, I know very few startup companies that have margins at all. So are you talking about projected margins or existing margins?
Yeah, so existing gross margins. So if you're selling a SaaS software and it's $100K subscription per year, all right, it costs $20K to service that through account management or whatever you want to, or hardware, whatever costs there are to it.
Okay.
Yeah, or piggybacking on that too, as you're a startup and when you do your projections, you've really got to have your cost of goods sold laid out as a benchmark in order for you to perform against. And if you don't have that figured out in advance before you go to do it for real, you're not gonna have it on your mind while you're trying to get the work done. So just one comment on all these ARR metrics and gross margins and gross profits, they're all incredibly important, but set your targets before you do the work, because that's the only real way to validate your business model. Otherwise, what you'll do is you'll get the revenue, and then you'll reverse validate your numbers to make sure that they match up with what investors would find appealing. And then what you suddenly have is you can actually have a diversion in your financial projections from your actual performance metrics. So I guess that's a really long-winded way to say have your ARR numbers and have your gross margin numbers and your cost of goods sold projected out, albeit they may not be accurate. have them projected very precisely, so you have those KPIs to compare your performance against.
Okay. We had another question that said, what early stage companies are thriving during the current COVID crisis, and what will investor opportunities be as the economy reboots? So why don't we go ahead and let's see, Scott, why don't we ask you?
That's a tough question, and we're trying to figure that out. I think anything contactless delivery, anything that's disinfecting, anything coronavirus related, obviously, anything mask related is going to do well. We obviously don't invest in really any of those areas. Yeah. It's hard to say what's going to do well. I mean, we're sort of keeping to the same thesis, and we did a lot of health IT technologies. So things that a company called Citus Health, when we just invested in a couple of months ago, it was a patient engagement platform for home healthcare, hospice, specialty pharmacy, home infusion, typical type of deal we look for. It's really, really boring. Doesn't get anyone real excited, but it solves a huge issue that's pretty universal in a couple niche industries that no one else is paying attention to. And it's a big enough industry that they can have an exit in that looks good. And they had good traction. They had good presence. They already had good channel partners. All the big ones were using them or wanting to use them. And a company like that will do pretty well because they have a telehealth component. It does actually do a lot of at-home type care type things. and their clients are not getting hit by this at all. They're still billing, they're still doing well. And we're probably gonna stick more to health IT. Cyber hasn't gotten hit real hard that I'm aware of, at least yet. Health education's doing pretty well. Like a company like Osmosis, which was based in Baltimore, is doing really, really well. Education technology, to a lesser extent, is doing fairly well right now. Some pockets are not doing well, but a lot of them are doing okay. I mean, we're trying to figure that out, candidly. We don't really know what's going to not get hit real hard. I think everything's going to hit to some extent. There's one company called TrackStreet we're probably about to invest in that does minimum pricing and sort of tracks what's happening online for all these different brands and helps keep them off of sites that shouldn't be on, and enforces all their policies and automates it and does it all overnight on Amazon and Walmart and Target and everywhere else. And that's doing well and landing new customers, but it's hard to find ones that are not getting impacted in a big way.
All right, let's, Mike, why don't we go over to you? And then we had one of the attendees ask, since you talked about contactless delivery, what about contactless dating? So you can guess who asked that one. Go ahead, Mike.
Yeah, to piggyback on Scott's comments, still very much we're seeing where everyone's getting hit. So for example, cybersecurity companies have a valuable service that isn't going to, the need for that's not diminishing just because of COVID, but the customers they service potentially have an impact because of the underlying business models that they have. So there's some second and third order effects that are impacting some of our companies that have some of these underlying contract risk. We're looking at companies at the intersection of cybersecurity and ed tech because virtual and remote training is not going to go away. Health IT is not going away, but we're not smart enough, like Scott, to invest in it. So we were looking at companies in the software solution for event companies. Fortunately, we didn't pull the trigger on that one before COVID, because that's not, unfortunately, going anywhere. Maybe they'll pivot like Tim did, but we're figuring it out.
Okay.
Well, I just want to, hey, Carl, I was going to throw in one thing. The other thing, I'm on a board of a company that does collaboration software for designers and developers. And that, I think, is an area that's very hot. I mean, you could see like Zoom and whatnot, but there were demonstrable evidence at board meetings of like users signing up and plans being purchased. It's going up drastically just because of the fact that everybody's remote.
Yep. Well, I'm happy to say Zoom is our client. We took them public and they're thriving during this time. So there's an example of one that's thriving. So we've only got 5 minutes left. So I'm going to go ahead and I'm going to thank my panelists. I want to thank Tim, Scott. I want to thank Corey, and I want to thank Mike as well. And I'm going to kick it back to Kathy and let you do a wrap up. And then I want to leave us a few minutes where you all can talk amongst yourselves before we sign off, because I think networking is key here.
Absolutely. One real quick one. Back at 4:10, Gabrielle asked a question. I'm not sure if he was answered.
Oh, I must have missed it.
Well, there was so many that was going at that particular time. I'm just not sure if he got that answered or not.
Well, we can get to it live here if you want to just do the Fitzy wrap, and then we can let people talk. We can unmute them.
We're going to let people talk. I normally don't do a sales pitch. You know me. We speak the way I look at it is actions speak louder than words. And, you guys are all part of it. I kind of feel like, Fitzy has an amazing ecosystem, and it's pretty much everyone who's on this call. Entrepreneurs are, stretch all the way out to Texas. So all I do is bring them together. And then
for those of you who don't know what Fitzy is, that's the Frederick Innovative Technology Center. And I'm chairman of it. That's why I'm sitting out in front of the building that Kathy is actually inside right now, aren't you?
No, actually I'm at home.
Oh, you're at home. Okay. All right. Well, let's go ahead and unmute and see if this doesn't get too chaotic, but let you guys talk a little bit and we can listen.
If anyone wants to ask questions, I'm not going to go anywhere for a little bit.
I just want to thank you, Mike, for introducing me to John S.
Yeah, no problem. So I'm excited to hear what your update is since last time we spoke, and I'm glad that connection was helpful for you.
Yeah, we're still, working it out, but you never know, right? It's all good. And Carl, thank you for allowing me to pitch it in a couple of months.
Yeah, we've got capital call coming up. It's going to be virtual this time. We've got the technology one on May 27th at noon. And then we actually have a digital health and life sciences one that we're doing June 4th because we had over 70 applications. So I'm excited about that. A little nervous too. I'm glad I get to do this as a warm up before we're going to have, a lot of people on the capital call.
I really appreciate it, and it's an honor to be able to be there. So thank you very much.
All right. So if nobody else is going to be jumping on and asking questions, I'm going to ask one here. And I want to ask Scott if you're hanging around. And so everybody's popping off so fast I can't keep track of who's still here. But let's talk about when you do early capital raises. I had an entrepreneur come to me with a PPM and a finder. How out of the norm is that to have like a placement agent and a PPM? Scott, if you don't mind addressing that, or Mike, either of you.
I'll take the first stab. It happens. I see it. It's, I don't know the good way to say it. It's kind of a red flag when I see it. I mean, raising money for a really early stage company, especially a pre-revenue company, is unbelievably, it's very, very hard. Hiring a placement agent at that stage is not a great sign for me. At that point, that means there's no demand in the market probably at all anywhere. They need to go to someone to actually help them, or they can't figure out how to pitch their own vision, which is another red flag. PPM, I'm not even gonna bother to read. It's gonna be 60 pages. Like when someone sends a 50-page business plan, I'm not gonna read it, especially at that stage, because it doesn't really matter. It's so early that traction is what's gonna show me is this real. Feedback from POCs is gonna show me what's real. I remember Round Trip, one of the companies I actually did invest in, had a business plan when they were almost pre-revenue. They had like $100 in revenue. They had pretty much no revenue. And it was like 40 pages. And I remember looking at Mark, the founder, and telling him, like, what the hell did you write this for? Like, no one's actually going to read this. No one that you actually want to invest is going to read this. And he distilled that down to a pitch deck, which was like 10 or 12 slides, and that made more sense. But can't speak for Mike, but I don't think you'd actually bother to read a PPM,
Right.
would you?
Well, before Mike answers, I had somebody ask, what is a PPM? So a PPM is a private placement memorandum. So sorry.
So we didn't even write one for our fund. I certainly don't read them for founders. So echo everything Scott said.
Okay. All right. Thank you.
Oh, can I add one thing on that?
Who's talking there?
Corey.
Oh, hey, Corey.
Yeah, sorry. Just like one thing to you guys, just like when you're going out and looking for investment, and there's a big difference too between everything that does go into a pitch deck that an investor might actually read should be backed by incredibly calculable and incredibly specific projections and market analysis. And Scott, feel free to disagree with me on this, but I just don't want to confuse any of the CEOs out there. Like, it's not that there shouldn't be 40 pages of substance to your actual business and plan, whether you put it into pages or slides or Excel or whatever you do. The substance there has to be incredibly real. I think what Scott and Mike are saying is, by the time it gets to the investor, it has to be boiled down to the KPIs that are of interest to them, that they can digest in a comparative manner to all the other deals they may want to look at.
Okay, and then Corey, another entrepreneur said, are entrepreneurs actually doing business plans today? That's a good question. I remember back in the 90s when I was doing my first startup, I wrote a big, 100-page business plan, but I haven't seen a business plan. I've seen executive summaries and pitch decks.
Yeah, that's all we've been asked for on the investor side, or even the customer side, or strategic partner side, or anybody. It's funny because I think sometimes the investor memos that get prepared before a deal actually closes exceed per word the gross material they've actually received from the entrepreneur. That absolutely aligns. Now, I mean, behind the scenes, I have multiple Excel files, a book of strategic documents and market studies and things like that, but yeah, those never get exposed publicly.
I think another way to rephrase the question is, how do you go about finding investors if you're an early stage founder. And if you're not a serial entrepreneur like Tim or someone else in the room who's got these pre-existing relationships, it can be daunting and certainly is a challenge. My biggest piece of advice is not to go hire a placement agent. It's to find the super connectors like I think Kyle McQuiggan's still in the room right now, or Carl Grant, and they will listen to what you have to say and connect you to the best folks in the network who could be a fit. And from the investor perspective, that serves as an immediate filter for me. I mean, I get tons of inbound pitch decks and LinkedIn and email, but all the deals we've done have come in through warm intros from connections in our network who've been that first, not line of defense, but screening tool for us.
Yeah, so if I can give a shout out to Kyle, I see he's muted down there and he's hiding, but Kyle's going to be a better version of me in 10 years. He's really good at what he does.
I got a question. This is
Yes,
Eagles.
go ahead, Eagles.
Yeah, hi.
Good to see you.
Very good discussion. I wanted to ask about startup companies that get started with federal grants, contracts, SBIR. In other words, non-equity investment essentially by the feds. Just wondering what your experience has been with companies like that. Lessons learned about it. Is it a good way to get started as opposed to giving up equity, in the early stages?
I'll comment on that if no one else does. I do not have an SBIR grant myself. I have very good friends with a number of CEOs that have started their businesses that way. I have two primary takeaways, which I'm sure there are other people on the call who can offer more in-depth thoughts, but I'll be brief. Non-dilutive funding's great, but make no mistake that funding is going to be heavily directed at satisfying the metrics of that RFQ, right, or that RFP that the SPIR or STTR is laid out. I think the other thing that you have to keep in mind is pursuing an SBIR and doing that work does not always align with your business plan, because I don't think the investor is necessarily interested in your ability to capture an SBIR. I think they'd be more interested in the intellectual property that you can take to market from that SBIR, and how are you going to, what's your route to market and your plan going to be kind of post executing that work.
If I could throw in, Eagles, I don't think I can remember seeing a company that's gone from an SBIR to venture backing. I'm sure it's happened, but it's very rare. I think SBIRs are very addictive. And once you figure out how to get your hands on that money, then you end up getting really good at getting that money, and you create a business around getting SBIRs.
Biotech is almost the only way they can do it.
Biotech?
Biotech, it's really the only way that they can do it.
Yeah, so everything we're talking about here today in terms of like ARR and all this stuff, this does not apply to biotech companies. Yeah. All right, so this is a technology discussion. Biotech, it's a whole different world. I've got like a 20% of my time into the biotech space. I still don't get like how they come up with the stuff that they come up with, but they'll raise $100 million and not have any revenue projections for 5 years. So, scrap all of these discussion points today. Oh, and we've had a question. So this goes back to the PPM. And the question is, if a placement agent says they have 1.71 million of 2.5 million in pledges, would you recommend ditching the placement agent and going direct to investors? But this is a real situation here. What do you guys think? That's a tough one.
I'm not qualified.
I guess what does that actually mean? Does that mean they have 1.71 million committed for a round?
Yeah, verbally committed. I guess it's not in the bank.
I mean, if they have it committed, I'd ask what terms. You probably had to sign something setting the terms for it. They probably take a percentage of that, whether it's 3% or 10% or 20%. I guess it depends on what the terms are. And it also depends on what the terms of the round are. If you got really good terms in the round, 20%, it's high. I mean, but it's capital, and it's hard to get capital right now. If the terms that you said are aggressive enough and good enough, then I mean, then maybe.
Yeah. What's the saying? A bird in the hand's worth two in the bush, something like that.
All right. Well, look, you guys, this has been a great conversation. I appreciate you all showing up today. Kathy, thanks for pulling this off. And I'm going to go watch the COVID press conference to see what we can expect now, if we're going to be injecting bleach or what the heck the next thing is that we're supposed to do.
Thank you, guys. We'll send this off. Anyone who's put their LinkedIn profile in here, we'll send it off to you after this event, probably tomorrow. We have another.
Okay.
So you guys have a great evening.
Thanks a lot.
Everything.
Thanks.
Bye-bye. All right.
Thanks.
Take care.